You're listening to Brandon Boost. Brandon Boost. Brandon Boost. Brandon
Boost. So welcome back to episode 7. It's been a while. Can't remember how long the last one was. About 6 weeks ago. It'll be too long. So today we're talking money masters, mastering e-commerce finances, and just talking about all things finance, planning, budgeting, I guess, anything finance related. And I want to introduce Julie, who is from Cygnus Consultancy, who's an expert and a CFO in finance, obviously. Yep. And I'll let you introduce yourself more.
Yeah, so hello everybody. I'm not sure where to look today.
Somewhere over there.
So I'm Julie, as Ben says, Cygnus Consultancy, and I'm what's called a fractional CFO. So it's not a term that's commonly used in the UK. To be honest, most people are used to the term portfolio, FD, CFO, or interim FD, CFO. A fractional CFO is very similar, except for the fact that we work fractionally for lots of different businesses. So lots of companies will use my services on a part-time basis, and that's really good for companies particularly that are scaling up, or they're not quite ready for a full-time FD or CFO yet, or perhaps have just got a particular challenge that they need to overcome at this moment in time, so they need a bit of extra help to do stuff to get them over a hurdle that's coming up. And that's where I swoop in and help out and add value to those businesses, helping them transform their profitability and growth.
Sounds good. And Julie's working for us as our fractional CFO as well, so We're very glad to have her expertise on board.
Thank you.
And so far so good. Lots of good stuff. Just jumping in, I guess. So what's your core sort of services? What these startup, scale-up businesses, where do you usually fit in, and what kind of things do you usually get stuck in on?
Yeah, so it does vary a lot client to client, but startups specifically, it's a lot more about getting that financial expertise and resilience into the business. A lot of people who have gone into a startup, it might be their first time running their own startup, and they often don't have the tools or the expertise to navigate some of the waters coming ahead, and they'll miss something big. So cash flow is usually the biggest issue with startups. A lot of owners have to plough their own funds in, and sometimes they're not quite prepared for that, or maybe they don't realise, all the costs that are involved in setting up a startup as well. So it's just making sure that they've got a lot of plates they're spinning already, and a lot of owners that try and do the finances themselves. And what I often find is that I'll go in after 12-18 months as the startups started to really gain some momentum, and there's potentially a couple of issues there, or I start looking at the accounts and I need to start to give them some financial resilience in the business and starting to help them plan for the future. But actually the basis that they've been working off to make a lot of assumptions is incorrect, because a lot of owners do their own bookkeeping to start with and those sorts of things. So often I kind of go in with a remit, and then I kind of get shifted onto another remit to get all the foundations right. And then it's important to have the right foundations before you start building anything else on top of it. Otherwise you could just be actually building more issues into the startup rather than helping them out there. So that's one of the areas I tend to get pulled into. And then it's also where fundraising is another big area. That could be via investment, or it could be like, do we get a loan? And a lot of it about it as well is also looking at working capital. So are there areas of this business where they've got the working capital tied up? Could they free the noose around the neck a little bit on that as well? And what areas can I kind of help them focus on a little bit more? And it might even be stuff like looking at revenue and, well, let's have a real deep dive on how you're actually making money and how you could make more of the right money and less of the wrong money.
Yeah. Don't want to be busy fools.
No, exactly, yeah.
No. So I guess you obviously, because you work with lots of different types of businesses and different levels and scales and everything else, is there a few things that business owners often do wrong or don't do so well that you sort of commonly end up having to either fix later or would have been better to put in place earlier?
Yeah, so I mean, commonly the biggest one is always that they've tried to do their own bookkeeping, and then things are just all in the wrong place on the balance sheet and stuff. often I'll go in and actually they've got an improved like balance sheet by me going in because they've put stuff in the wrong place, but sometimes there's something like horrible hiding under the rug that they didn't quite realise about. So I'll go in and help with those sorts of things, particularly with e-commerces as well. You've sometimes got issue with inventory and stock as well. So there might be a busy period coming up, let's say Black Friday's approaching for an e-commerce, and they want to go and get a load of stock because they know they get lots of orders then, but they might have no money to go and actually buy the stock. So unless it's a dropship style business, it's kind of like, well, how are we going to maximise the opportunity of this thing coming up? So, you know, it's all about doing that financial planning up the front to kind of look at, like, you know, if Black Friday's in 3 months, let's start thinking now about how are you going to finance that inventory. And I also see sometimes with startups as well, it's almost like a false economy. So they'll perhaps get like a job lot deal on a load of stock, which then ties up a lot of their working capital, but then it doesn't sell so well, or the stock goes obsolete, and then suddenly they're just sitting on a pile of something that's useless to them. So it's just thinking sometimes about those deals that crop up as well, like, should we do that? So you've got to manage your risk when you're doing that as well, because if that then means you can't buy stock in your other product lines that are actually your bread and butter, you just got to be really careful that you're weighing up all those risks as you're doing stuff too.
Yeah, I think it's certainly some of the stuff you worked on with us around like forecasting and things like that, and looking at, I guess, the different opportunities and then making an educated call on it, I guess. So like you're saying with the stock, you might think it's a good deal, but then if you're stuck with it, or even if it just ties up your capital for ages and you can't then utilise that on a better opportunity, or, you know, there's risks around, I guess, finger in the air, kind of hoping for the best, or salespeople trying to flog some stock to you that sounds like a good deal, but not necessarily what your business needs.
Yeah, and it's also using all that data that's around your business as well. So some of it's in the account system, some of it might be in your, I don't know, Shopify or wherever sales managed system you have. So a lot of businesses have got that data, but they're not quite sure what to do with that data. So I like to start like looking at clients, like have you got clients in different sectors, for example, or you know, if it's all D2C, you know, what's your sweet spot? How much do people need to like check out for you to like start making a profit, break even like start helping them look at things like lifetime value. So if it's literally a brand new startup that's literally started that week, you obviously haven't got that data, but then you can look at what else happens in the industry. But if they've already got the data there, that can often tell them a lot. And sometimes what I see in e-commerce is as well is they'll run big like promo campaigns on products, and then when you actually look at it, it's like you're actually promoting your like lowest profitability item or even a loss-making item. And unless you've got a strategic reason for doing that, you know, that's really going to burn your cash flow quite quickly. So it's understanding the behaviours of the customers as well. So I'm not a behaviours expert with stuff like that, but I can work closely with people like marketing agencies as well, or in-house marketing teams. So just starting to like figure out, like, you know, what should we be pushing as well, and thinking a bit more about when you're doing promos, and what type of clients you're going after. Because sometimes it's just easy and people get comfortable with the types of clients they've got, so they just keep getting more and more of that type of client, but actually maybe it's not the best client for them as well.
Yeah, definitely. I think that you mentioned about promos, one thing I see quite a lot is when people do free shipping, things like that, which I get it because a lot of customers want free shipping, mainly just because it makes it easier to work out what the real price is rather than to go through 3 steps of checkout, whatever. But if you give away £5 or £6 on your delivery, you know, you've got to sell so much more or charge at a much higher price to recoup that money. And I think a lot of people haven't done the calculations, and also looking at, you know, where is that sweet spot. You know, if you're doing free shipping on all items or all items under £30, and you're never going to get that profit back, like you just don't have enough in it. And people don't seem to calculate where that sort of sweet spot is. And if you get the extra 50% of orders or 30 orders because of free shipping, but then it's not actually worth, you know, the difference. And sometimes just pricing fairly and clearly is fine.
Yeah, and you've got a lot of big companies doing it really well, so they'll know exactly the break point, and they'll have customer loyalty schemes. It's like, if you join our newsletter or, become a subscriber, then, you'll get free shipping, or it's a lower free shipping value, but it's understanding, how much do I need to sell before I can offer the free shipping as well. So I had my own e-commerce too, and that was one of the first things I did, because I wanted people to, you see a lot of people leaving checkout when they start to add on the shipping, especially if they don't understand that's coming down the line. So one of the first things I did with my e-commerce was I worked out the break point where I could start to offer free shipping. And then I was really clear on a little banner at the top that shipping is free over this amount of value. So there was less people abandoning a checkout then as well. And I also knew exactly how much I was going to make. Whereas I think a lot of startups kind of go on a wing and a prayer a little bit. They like just get the customer in the door and then they'll like repeat custom. But not all customers do that. Average repeat rate's different per e-commerce. So it's understanding what's your likely repeat customer rate as well, because if it's really low and you're doing that as a thing to acquire customers, then you could actually be setting yourself up for a lot of losses.
No, definitely. And I think a lot of businesses don't realise that the returning rate is quite low unless you've got really great loyalty or like a subscription type business. Most people seem to only buy a couple of times. So I think that's really interesting that you mentioned about, I guess if you're going to do the free shipping in particular, trying to get the customer to do something else, to kind of earn it, like giving your, permission for a newsletter or something, because then at least you can be carrying on promoting to them over the next 12 months, and you've got chances of bringing them back, putting them into a retargeting campaign or something to keep them going. So for any, I guess e-commerce store in particular, because that's what we focus on and you've worked with, but potentially for all businesses, most businesses will have some accounting package. They might do some of it themselves. They've kind of got an accountant, probably just doing it once a year, and probably don't have a bookkeeper yet. What are the most important things that they should be aware of and looking for and sort of tracking in their business? And is there any other reports or sort of Excel spreadsheet that you could pull off, be it a budget or a cash flow or something that, is there something that would be useful for them to be doing to kind of keep abreast of things? Obviously, I guess the thing is not just assuming you're doing your accounting right in your bookkeeping software, not just doing it for the sake of doing it. Like if you don't look at any of the reports, it's kind of irrelevant until the end of the year. Just talk about that.
Yeah, I mean, assuming that your bookkeeping is being done right and everything's in the right nominal codes and everything, I always make sure that I'm building a forecast so that I can see if there's, especially a lot of e-commerces have got a lot of seasonality built in there. So I'll be wanting to pull off a forecast. I'll be wanting to look at the financial year ahead. I'll use data from the previous financial year to see where it ebbs and flows, and I'll be pulling off the sales income forecast. So I'll look at what clients normally spend. I'll talk to the business owners, or the business owners themselves can do this. Just make sure you've pulled down your customers. You can kind of see what they're typically spending. If you're in e-commerce and it's direct to consumer, then it's going to be a little bit different, because you'll just be looking at your typical patterns, like month on month what they do. If you're growing at a steady rate, you'll want to build a bit of steady growth in as well. But you also need to factor in like risk about what if sales drop off less than we thought as well. So managing the overhead section of it, so things like your rent, your rates, your salary is absolutely key. Direct costs are very closely linked to your sales revenue, so you need to understand your overheads. And for example, if your overheads are over the £10,000 a month or £50,000 a month, that will very quickly tell you. If you know your gross profit margin, it will very quickly tell you what sort of revenue do you need to be doing each month. And I've worked with e-commerces as well, and say for like 2 or 3 weeks into the month, and I can see they're going to have a burn this month, and maybe the cash is low in the bank. They might want to do a promo then towards the month end, although I hate it when people do promos
Yeah.
too much because customers just desensitised to your normal pricing then and just wait for the promo all the time.
Yeah.
So it's just making sure that you're aware of those bumps ahead, and that varies e-commerce to e-commerce. Some of them have, you know, got plenty of cash in the bank, and you know, you don't have to keep such a keen eye on it. But when you're in startup mode, a lot of the times, you know, you need to be checking on your bank like on a daily or weekly basis, and just making sure that you can pay all the things that need paying. So, you know, HMRC, don't really want to be messing about with those. But they will actually listen if you have got a short-term issue. You know, they are often quite open to working out a payment plan with you. And then I also see some businesses, it's a nice thing actually if you've got to pay corporation tax, because a lot of people moan about it, but if you're paying corp tax, you're making profits. So I see that as a good thing. But I see a lot of businesses like they forget that they've got a corp tax bill coming up because it's a once a year thing. So I've seen businesses that have forecast cash flow off the P&L, and so VAT's not in their cash flow forecast, and then suddenly they've got a massive VAT bill to pay that they've just totally forgot about. So it's just make sure that you're running your cash flow forecast, because you can actually have a profitable business and still die over cash flow, because maybe you've got a loan that's not hitting your P&L but it's still being paid out of the bank. So making sure you're aware of all those. So you can just start with a really basic forecast where you've got your revenue, your direct cost, your overhead, just see what profit you've got left, and then make sure you add some extra sections on your VAT, your PAYE and all those sorts of things. I prefer to run a 3-statement cash flow which feeds off the balance sheet, so I can even see movements in if a director wants to take some of their director's loan out or put some money in. So I prefer to do it that way, but unless you're an accounting professional, you probably wouldn't understand all that side of it. So just make sure you've got the fundamentals boxed off.
And on the fundamentals, just the basics, because I think people do get confused with some of the terminology and things. A high level, what is gross profit, what is net profit, and also sort of what is EBITDA, which people always talk about.
So high level, you've got your revenue, and then your gross profit is basically the direct costs associated with that revenue. So if your business is having a high salmon, the direct costs normally go up in line with that. Not always the case in things like SaaS businesses, but in an e-commerce, you're selling a product, you've probably got a typical idea of what your gross profit margin is. So let's, for argument's sake, assume it's 50% gross profit margin. If you know you typically work on that type of margin, then you should know that if you sell £100,000 of goods, and you'll have about 50% direct costs, and that will leave you about £50,000 then to cover your overheads. If you know your overheads are going to be like 40 grand, you know that you're going to, you know, have a net profit of about 10,000 per month. So your net profit is the bit after depreciation and interest and tax and stuff as well. That can sometimes catch people out on that, because writing down your capital expenditure, it hits the P&L, but it doesn't hit the cash flow at the same timing. So EBITDA is the bit that cleanses that out. So it stands for earnings before interest, tax, depreciation and amortisation. And the reason that EBITDA is such an important measure in a lot of businesses is it's kind of used as a cleansing profits really. So let's say you've got business number one, and that's got a £200,000 loan to finance its operations. That's going to look very different on a net profit business to a business that hasn't got that type of funding and has perhaps brought a lot more capital expenditure. So capital expenditure is something that helps you actually grow your revenue. It's called CapEx because it's something in the business that keeps generating your revenue. You know, you'll buy racking, then you can, you know, have more stuff on your racking. You buy more computers, then you can do more work. So it's kind of a growth thing. When you're buying CapEx, it should be helping you grow or maintain your operations. And EBITDA takes all that complexity out, so you can actually benchmark one business against the other. And it's why when most businesses come to a sale, it's usually off an EBITDA multiple. Okay. And that's simply because when the business sells, often all those things that are affecting the net profit are kind of cleansed out on a sale. So directors' loans will be cleared, you know, business loans with the bank might be cleared as part of it as well. So I just want to see, as an underlying business, how does this look against the rest of the industry?
Perform and things.
Yeah.
And I don't know how many businesses have this, but what's the difference between like cash accounting and sort of invoice accrual accounting?
So when you're over a certain threshold, and I can't remember the threshold, so but basically it's cash accounting is literally as things happen through the bank. I go into a lot of businesses and I get their stat accounts, and it says that they're accounting to FRS 102, it's often called, and it's on an accruals basis. And then when I actually look at their accounts, they're actually accounting on a cash basis, and that tends to be very similar in terms of what you're doing in terms of revenue. But in terms of cash accounting versus accrual accounting, let's take something like your rent. Let's say that your rent is £30,000 a quarter. On cash accounting, often your landlord will want paying the month before the 3 months, so you'll have this like weird thing going on your P&L where every 3 months you've kind of got this 30,000 going on your P&L, and then it looks like you're quite profitable the 2 months after. Accruals based accounting means that when you get that 30,000, you apportion everything across the months that it relates to. So it's a good check at the end of month as well, that you can also see stuff like, let's say, paydays on the first of the month, but the work was actually done the month before. You'd want to put the cost of doing that work in the month that it relates to. So it's about having all your costs in the month that's associated to the revenue that has been generated.
And there is that threshold where you are meant to be using like that type of account.
Yeah, I can't remember the threshold off the top of my head, but when you get to a certain level, HMRC want you to do accruals based accounting.
Thinking about cash flow, cash is king. Do you have any tips on how people can improve their cash flow? I guess either in terms of reducing cost or just in sort of better management of cash and how maybe you pay suppliers or key stakeholders and things like that.
Yeah, so I think that's the first thing that springs to mind a lot of the time when people are like, I need to improve my cash flow. They always think about cutting costs, and I always say, like, cut costs but don't cut quality, because that can really damage your business as well. So there's daft little things you often find in people's accounts. So if you start looking through how many subscriptions are going on, for example, a lot of companies are subscribed to stuff they don't use anymore. So if you need something for the business, like, you need it and you need to pay for it, but if there's stuff there that's just dead weight, you're not using it, just get rid of it or like taper it down. There's also negotiating with your suppliers. A lot of startups are probably a little bit like fearful of negotiating with suppliers, but if you've been using a supplier like for a year and your business is going quite well and you've paid them on time, go back, ask for discounts, just say, right, okay, my business is on this like growth trajectory, we're going to be really big, I want to keep you on board, but let's talk about what you're charging us and how we can make that better for both of us, because if you're growing, that's good for your supplier as well. So you're not asking them to give you anything, you're kind of asking them to build a long-term relationship with you. So I'd look at negotiations that way instead. And then there's often bits on the balance sheet that are overlooked in terms of helping your cash flow too. So inventory's a big one, especially for e-commerces. So if you're a dropship e-commerce, you're not going to be worrying about that so much because your cash is in the bank before. So if there's items with some suppliers that you can do on a dropship way as well, that would be worth chatting about with them. You can often have APIs or FTPs that link back to each other's systems to build that in. So it's almost you're buying like a just-in-time basis on it, and then it's just making sure as you start going obsolete, how quickly is it moving round, and then you might want to take off your website really slow moving lines, and also the size of the lines as well. Warehouse space isn't cheap, so again, this is where people like Rapid Pack can step in. It's such a headache for e-commerces, and nearly all e-commerces I work with, when they get to that point where they're like, I need to get a warehouse to like house this stock and do fulfilment, it just takes so much focus away from the business owners as well, that they're not then selling their e-commerce stuff. They're now focused on running a logistics business, which is a totally different beast to an e-commerce business. So that's a time where you might start to think, right, okay, getting our orders out quite a lot now, and could we actually focus more on running our business? So outsource things to experts that you're not good at yourself, recognise that area of it, and stuff on your balance sheet as well. It's have you got stuff coming up for payment that could be like delayed a little bit? So you've got your aged creditors, so that's how much money you owe your suppliers. Can you broker better credit terms with them? Often in a startup they'll go, we want pro forma invoices, pay up front. But even if you can start changing that to like 7 days, then 14 days, then 30 days, then 60 days, that will really help your cash flow. And then also on your debtors too. So if you're a D2C, probably not such a thing, because people are paying before you even dispatch it. But if you are more B2B, then make sure that you're chasing your clients in, so don't let payments lag. If you can set up stuff like Go Cardless, for example, or direct debits, that's obviously much better. And it means you haven't got to spend a lot of time on credit control then as well, because it's automated. But it can be quite scary making that first step to say to clients, like, this is the way we do business, because when you're in startup mode you don't want to turn business away. But I think there comes a point where you realise that if you've got a set framework for how you do stuff, it'll just make life a lot easier for yourself, and your clients and your suppliers have got clarity too.
Yeah, definitely. I think as well, it's good to do it as early as possible, because it only gets harder to try and, if you want to then ask your customers to go on to direct debit or to change their terms after, they're going to be a lot more likely to push back and say, no, we're quite happy doing it how we are. And as you grow, having that in place is so much easier, just knowing, use Go Cardless, the money's going to come in on this date. Their fees are pretty fair. It's just easier. And if it fails for whatever reason, they'll recharge it automatically. All that kind of good stuff. So changing tack slightly, technology and automation, all the talk these days is around AI and ChatGPT and things. How do you, just sort of in a more general space, I guess, how do you see that playing out over the next couple of years with, scale up businesses? How do you think they might utilise AI? And if there is anything around accounting and finance, then I'd be interested to hear that.
I mean, for me, AI is absolutely amazing. I use it quite a bit on my day-to-day now, so I'm still learning quite a lot about it, but I just think it's a fantastic tool. But for me, it is a tool. It's nothing more. I don't think it replaces people. I think it frees people up from mundane tasks, because people just think differently to computers. So if a computer can take away mundane tasks, and yourself, you're an entrepreneur, so how many great ideas do you have while you're walking the dog, having a shower, driving to work? When you're actually at work doing the work, you're not having those great ideas. So for me, AI is something that takes all those things off your plate. I always think you've got to sense check what it's giving you at the minute, fact checked on it. But for me, it's something that's going to go a lot more into the predictive side of technology. So, if you've got data there and you can start to get AI to predict your customer trading patterns or buying habits, then that's going to help you focus better marketing at them, give them better products, better services. So for me, it's all around that side of it. And in terms of the finance realm of AI as well, I know a lot of people are, AI is going to take all our jobs and stuff. So I know at the moment AI can't do everything that I can do. It might be able to spin up a spreadsheet a little bit quicker, maybe in the future, but then to me that would take a mundane task off mine or my client's desk anyway, to help us think about a bigger picture anyway, and do stuff that's a bit more of a helicopter view of the business.
Yeah, I think definitely. I mean, whether it does all replace us or not, I guess we'll find out over the next 5 years or whatever. But certainly it seems to be very good at empowering, and certainly for us and for me, you're just able to, like say, ideas, you're able to iterate faster, and even just get it to a point that maybe you can explain it to somebody else, be it a finance person or a developer or whatever. Maybe there's a bit more substance to what was in your head than just, can you do this? And then they're a bit like, I don't really know what you're asking. So that works nicely. I was talking to an AI expert the other day, and as you were talking about, with predictive and sort of statistic and analysis and things of whatever it is in your business, the one thing he'd said, his top tip was just make sure you're collecting data like now, even if you don't know exactly what you're collecting it for.
Yeah.
So it might be all of your stock data, how it moves, your customer data, how they interact with your website, just having a big data dump that's consistent, so that in 12 months' time, when maybe, some different software AI is a bit more, developed or available, you've got it and you can just be like, here's my data, take it and do it. Because the big thing there is, if that comes out in 12 months' time and you've not started recording, it's got nothing to go against.
Yeah.
And computers can make very generalized assumptions, but it's not your business.
Yeah.
So if you can just, maybe you do an export from Shopify once a week of all of your sales data, all of your anything data, and you just store that in a folder, as an Excel sheet, keep it away every month, do that. And then in 12 months' time or whenever that software is available, you can just say, here you go, here's the 12 things. I want to know who is my top customer who spends over £50, or customers that you don't even realize are there, or products that are actually really great movers. Because again, I've seen with products and sales, people will often look at it like, what's the total number of items I've sold?
Yeah.
Or, over a certain period. And you go, well, you actually only bought 100 and they sold out in 2 days.
Yeah.
You're not looking at how quickly it sold. You're just going, well, I've sold 100 as opposed to 1,000. And there's things like that, which, a real person who's got experience will usually find. But if you don't have that person, software can do it quite well.
Yeah.
But it needs the data to kind of back it up.
You've got businesses like Walmart have kind of got software that does those sorts of things for them. It'll predict, like, if they're having a promotion, how many of these toilet rolls do we need to buy in and stuff, because they've got the big data. But those systems cost, I'm not kidding you, tens of thousands, hundreds of thousands every month to have that software, because it makes them millions and billions a year. So to have that sort of stuff available to smaller businesses will be really fantastic. Help us all kind of tap into that information.
It's democratizing AI, isn't it? That's the thing, and that's what's shaking it up. The fact that, even if you pay for ChatGPT at the moment, it's maximum $20. Whether all that changes, and there's obviously a lot of software being built into the AI technologies which are not free, although loads are in beta at the moment because they're so new. So there's a lot of good stuff out there, but whether it becomes free, and I guess the only thing we don't want to turn it into is a load more subscriptions, because that's the only downside. You're like, oh, it's only $20. Even for my AI sort of bag, I've probably got about 4-5 subscriptions to things. It's probably cost me like £200 a month.
Yeah.
Sorry about that. I guess just sort of a final sort of roundup. Any top tips, financial performance that we haven't talked about, or just things that people definitely need to be aware of, and just whoever benefits from using your services, or any similar type of people. Yeah.
So my top tip would be get to grip with your finances, because at the end of the day, I don't know anybody who set up a business and they're just uber wealthy and they can just afford to do it as a hobby. So unless your business is your hobby, get to grip with your finances. Make sure that you have got accurate actuals coming out your accounts, because you're going to make bad decisions based on incorrect data if you don't. And then make sure you get yourself a forecast. Even if it's a really loose plan, just understand what are your goals for the business, where do you want the business to move to. And it's amazing how many people, once they've got a plan, how they start to move towards it. But then businesses who have no plan at all and they're just firefighting every day, you've got to be really proactive in your business if you want to grow it. You've got to start thinking about, well, how am I going to achieve that goal? And I always like to think about what's the big goal in 3 to 5 years, and then reverse engineer it back to where am I now, and what steps do we need to take to get you there. And that's probably when you might need an expert like myself to come in. It might be that you need support in marketing. You might need to outsource your fulfilment to someone like Rapid Pack. Just let you get on with doing what you founded the business for in the first place. Get back to doing what you really enjoy doing and what you're passionate about.
Nice. So where can they find, I guess, your website?
You can find me on LinkedIn, and then my website, you can find me on a website which is also on LinkedIn, but it's so cringe, I'm not sure I want anyone to go there, but I have got a website as well, which is www.cygnusconsultancy.ltd, and Cygnus is like the swan or the star constellation, so it's spelled Cygnus. And that was something when I started my business, I wish I thought about the spelling, because I get it misspelt all the time now. So, yeah.
It does always make me laugh with like radio adverts when they have to try and spell out the names, and then you're thinking that's not an effective name. Not saying that's not. I quite like the name, but some of them are there. Just some other developments on me in particular. So I've founded a new TikTok page called Ben_Rapid Pack. So we've got our Rapid Pack TikTok, and then we've got my TikTok. And what I'm trying to do on mine, because we're currently on a journey as Rapid Pack, we're growing quite quickly, and we're looking for finance and looking for investment, and basically doing everything that we've just talked about regarding cash flow and accounts and everything. So I'm trying to document my journey on there, so you can just keep an eye on it really, and just follow it, see how we do. I've been doing some pitches to investors, so you can see how that went and how I had to sort of interact with some of the questions, which some of them were like awkward questions. So it's interesting to see how it works. And you can be prepared for that. Hopefully at the end of it, we get investment. But I guess that remains to be seen. If not, it'll turn into like a soap opera. And just see. So yeah, follow me on TikTok. It'll probably end up being on LinkedIn as well at some point. But for the time being, TikTok. And I'll see you in episode 8. Thank you, Julie.
And the TikTok's very good, so follow it.